Yeah. So another concept that they can try to use to confuse you is taxation. So beyond the taxation of capital allowance that you know, sometimes the tax rates, where this is where this matters a lot. Tax rate between the parent country most times will not be the same as the foreign country where you are investing. I'm sure you agree with me. The rate in the UK is not the same as the tax rate in Canada. The tax rate in US is not the same as the tax rate in Japan. So which means you need to know how you make adjustments when you are calculating your net present value. For you to be able to assess that investment properly, you must as well understand the tax implications of those cash flows to know what exactly is net cash flows and what is actually not it. You need to charge additional tax. You need to reduce the tax, or what exactly is the implication. So what I'm saying, when it's not equal, means that it can be less, it can be more, it can be the same. But what we know for sure is that you won't have, most likely it's not going to be the same. Yeah. But for the sake of exams, most times what they give you is they give you a situation whereby the parent company is less than the foreign country. So that there's no, the parent country is usually more than the foreign country. So which means parent is more than the foreign, yeah. E.g., maybe the tax is 40% here and the foreign country is maybe like 20% or 25%, so that you will know that there's an additional tax that we need to consider when we're assessing that investment, because mostly what exists in your syllabus is the concept of double tax treaty. If you don't know what this means is just a situation whereby you have two countries coming together and having an agreement about how taxes will be treated in a way to avoid double taxations. So what you are saying is, if you paying 40% in the UK and you are paying, let's say, 30% in Canada, and you are a UK company, yeah, parent is UK company. Since you have paid 30% in Canada, UK company will only ask you to pay additional 10%. So they will not ask you to pay the whole 40%. But at the same time, they will not say because you have paid 30%, you can go and say no more. No, you will still have to pay. Can you guys hear me? Please confirm.
Yes, sir.
Okay. So I was explaining the double tax treaty. Very important to know that. Like, take for instance, let's say you have a Canadian company, yeah, that is trying to invest in US. So you are appraising a US investment. But in Canada, your interest rate, I mean, your tax rate is 33%. But in the US, it's 40%. For tax purpose, by the time you have gotten your cash flows, definitely you get in the US because it's US investment. However, you have to do the appraisal in Canadian currency. Yeah, which means you need to assess that investment as a Canadian company because they're a Canadian headquarters company. What tax rate are you going to be using? Let me ask you. That is what we're talking about here. So Canada is meant to collect tax at 33%, but US is collecting at 40%. So do you need to charge extra tax on that company if you are doing an appraisal? That's what I'm asking now, based on what I explained on double tax treaty.
Wait, what's our home country right now?
The, this is a parent in Canada,
Yeah.
yeah, and this is the investment that you want to make in the US.
In this case, I don't think so we will pay any extra tax.
So there is no extra tax, right? So
Yeah.
which means the tax will have been calculated at what rate?
I think
So because the company will be paying its tax in US at 40%. So for your appraiser, because you're going to be appraising as a UK parent, you are the parent that want to appraise this investment. So in this case, there is no definitely extra tax. So you are right, no extra tax in the UK because UK is sorry in Canada. Let's quickly write UK. So no extra tax in Canada because the Canada where the parent is investment have been charged at, I mean, income have been charged at 33%, whereas this guy is already even paying tax in abroad at 40%. So, which means you won't include extra tax in your cash flow estimate. But what about if, yes, it's 33% in Canada, but in US, it's also 33%? Any extra tax in the UK?
no.
No, because it's the same thing. That's exactly what we're saying. But let's say this is 33%. And here is say 18%. Any extra tax in the UK?
Yes.
So that's Canada, right? You're talking
Canada,
Yes,
about.
UK.
sorry, in Canada.
Okay,
Yes,
Because
okay.
sir.
because I'm in the UK, it's just it's only UK that comes to my head. Sorry. So extra tax of how much?
15.
For Canada, 15. Because in Canada, they expect income to be charged at 30%. And this guy will only be, I mean, going with 18% tax in the US. So, which means that part of that income, by the time it comes back to UK, will still receive extra punishment, extra charge. So we need to still consider that in our tax, in our cash flow computation. So when you're projecting cash flow, and we'll probably use one or two examples to check that. When you're projecting cash flows and you know that you have only paid at 18%, there's extra 50% that you will need to include as tax cash out, as cash outflow, which will be a tax expense in your cash flow projection. That's exactly what can also be included in your tax complications. Remember what I'm doing? Always want to do it in piecemeals with you so you understand the concept before you now go into a question where you can sell them. Because you can see a question that will include these tax problems, include you to forecast, will require to forecast exchange rate, and you need to know how to deal with them individually before you put it together in your NPV calculation. Very
A quick
important.
question.
Please go ahead.
What if you invest in a foreign country, let's say in US, and rather than
Yes.
bringing the profit back to your home country, you reinvest again in the USA? Then what?
Okay. So, and that takes me to, okay, we'll get there when we talk about repatriation. Remember I spoke about repatriation when we started. So let me not, but I'll give you the concept right away, but we'll get there. The point there is if there is a restriction, which is regulatory restriction, yeah, stopping you from repatriating that money back to your parent country, then that money is not taxable. If it's a regulation, like it's beyond your control. However, if you are the one that have decided to reinvest the money, you will still be liable to tax in your parent company, especially if the rate in the parent country is higher than the foreign country. That's the
But you're not,
concept.
but
But
you're not bringing the money back, right?
yeah, but it's your choice not to bring it back. You are not
Okay.
restricted. Do you get?
Okay. Yeah.
Because you could have brought it back and still send it back to wherever you want to invest it. So how do I know that you didn't bring it back? But
Okay.
if it's like it's a rule, like US restricts you from sending money to your parents. So US has put an obligation on your head that no money should go out of the US. All the money must stay in the US. Then you will be exempted from extra tax of 15% or whatever the difference is.
And
And we'll see.
individual, company, both, or only company?
Is it only what? For
Is
individuals or
it
company?
is it applying for individual and company both, or only company?
Oh, so everything we are doing in this paper is for companies,
Okay, sir.
no individuals. Yeah.
Okay,
This is about companies. Yeah.
okay.
Very good.
So I just have a quick question, please.
Yes, great. Go ahead.
Yeah, so as you mentioned the last example that we need to pay like an extra tax of 15%. Going
Yeah.
back to the first example, which is example one, do we also need to adjust for I mean for the tax that you're talking about? Still on the tax that you're talking about.
Example one, which is
No, I mean
40%.
the first 33% and the 40%. Do we also need to adjust an inflow instead of paying extra tax since we are paying 40% in US? Because if, for example, we are like comparing two projects just for comparison purposes, do we need to maintain or stick to the same 33%? So in the last year, the last example, you say we might need to pay like extra tax of 15%. Do we, which is going to be an outflow? So in the first one, do we need to record an inflow of the difference between the 40 and the 33?
Okay, so that is clear. But you will not get any credit because in the US you are required to pay that 40%.
Mhm.
There's nothing you can do. You will pay that tax. So that will be tax cash outflow for you. Yeah. Your profit after tax here is the only thing that is left for this UK company to benefit from after the 40%. So the only thing is that you don't get to pay extra tax again. You just manage what you have. So you will not get credit, you will not get inflow. Because the UK government will not give you more money because you have paid more tax in a foreign country that does not come to them. So they won't compensate you for that. Yeah. Canada will not say, oh, because gone to the US to go and put your subsidiary there and you are paying tax at higher rate, then I'll be giving you credit. No. But the only thing is they will not tax you more. So there won't be double taxation. Rather, you only have to pay when you have not paid enough. So if you have paid exactly the same or you have paid more, you are fine. But if you have paid less, then you are not fine. You will have to pay more. I hope that is clear.
Yeah, sure, it's correct. Thanks.
Very good. Okay. So gradually, I'm moving to intercompany space. That's another part that you can face some confusion in foreign NPV calculation, intercompany cash flows. And I mean, it's also going to link us to the question from Ismail. Yeah. But what I'm going to bring out here, which is what they try to do with this type of question when you have intercompany cash flow, is a situation whereby they tell you that there is a payment from one company to a subsidiary. So it's now possible that the tax treatment, remember we're still on taxation, the tax treatment might be different in those two jurisdictions. And you probably remember your transfer pricing issue. Because also governments or tax authority has also realized that companies try to play smart, shifting profits to high tax regions and trying, shifting losses to high tax rate region and taking high profit to tax havens, those countries with either no or very low tax rate. Take for instance, if you have a UK and you have a US, if tax rate is 40% in the UK and it's 10% in the US, you know what companies try to do? Companies would prefer to make loss here or low profit, such that the tax that they will pay will be very low. For all their profit, they will shift it here because they know that with high profit here at 10%, the tax will also be low. So you can see in both instances, they have low tax. And how would they do it? Because the company in the UK and company in the US are the same members of the same group. They belong to one parent. What would they do? They will make sure that UK company is buying something from the US at a ridiculous high price. So maybe there is a material that UK needs. The market price of that material can be $1, but they can be selling it to the UK company at $100. That is a problem because that raises issues on transfer pricing. So sometimes, if you have a scenario like this, they will give you what the market price is. And in your calculation, in your cash flow estimate, you must work with market value, market price, because tax authority will not entertain artificial pricing because that is what you call as profit shifting, which is not acceptable. Right. So if you have intercompany transactions, number one thing is to make sure that you use the market value, which will be stated in the question. Is that to say the pricing that they have used is a market price, or they gave you the market price of the pricing? So you know that you need to ignore what the company has used, but rather work with what the market price will be. And any other thing you have to back out for taxes. Yeah. Is that clear, please?
Yes, sir.
Yeah. Okay. Yeah. Another part where these intercompany transactions can work is sometimes it might be a transaction between those two countries as well. And if it might be allowable for tax, which means here you can deduct it. But if here you cannot, you need to watch out for the adjustment. So you need to make necessary adjustments as well here. If you find yourself in that situation whereby something is not allowable for tax in the parent, but is allowable in a subsidiary or an investment, then you need to bring it back here and account for tax liability when you are doing your assessment. Like I said, all of these we'll put into practice when we do the calculation, but I'm just bringing out the concept quickly until we'll see and we'll do our calculation. Yeah. So those are few examples on how taxes can be funding your questions. Another thing is the one that Ismail actually asked, which is on remittance, which I've already explained, where I said that if there's a remittance restriction or what you call repatriation, saying that the foreign subsidiary is prohibited from sending money to its parent. Remittance restriction. If there's a remittance restriction, what did I say? Please know that you will not be paying tax on the money that you are not able to receive as a parent. So there won't be tax implication as a parent because the money will not come to you. The money is staying offshore. So you can actually avoid paying tax on that. Should I do a small calculation for you on this one? Let's see. Okay, let's do a calculation before round up with the last part. So let's assume you have a cash flow. Year one, year two, and year three. And so you have 3 million in year one, 4 million in year two, and 6 million in year three. So this is profit before tax. You have that figure, and this is in the US. Yeah. So let's say there's a restriction of 50% returns to parent. Parent company. US tax rate, 15%, right? The US tax rate is at 15%, and UK tax rate is at 25%. Remember, the parent is the UK company, yeah? It's a UK company. UK parents, which means the focus is in the UK. Yeah. But this money, remember, is in dollars because in US. Just a slight warm up for you before we go into big questions. It's good to see how you interpret this. So the cash flow is in dollars, but you are a UK parent, which means you need definitely you need cash flow to be in pounds. But that one aside, most importantly, you have a restriction on remittance, which is at 50%. So which means you can only remit 50% of these figures after tax. Right. I'll give you exchange rate. So let's say, so you don't have to stress, determine the exchange rate. So exchange rate applicable is at 1.3 and constant every year. So that's, you don't need to change it. Would there be extra tax payable?
Yes.
Good. So there'll be extra tax payable. Now, I want you to tell me every year, what would the extra tax payable be for the next 3 years? Where 1 year, 2 year, 3. And remember, there's a restriction of 50% on what can be remitted.
So on year number 1, it is gonna be 0.12.
Okay. Year 1, year 2, year 3. So year 1 is what?
0.12.
0.12
Yeah.
pounds or dollars?
Pounds.
Okay. Take us through, how did you do that?
So can you go up? Can I see the figure again? The dollar figure. So 3 million converted into pounds. So it's gonna be 3 million divided by 1.3. Then because there's a 50% restriction, it is gonna be multiplied by 50%. And then multiply by 0.1%, which is basically the difference between 25 and 15%.
Fantastic. Okay. Any other view? Go ahead with the year 2 and year 3. Yeah.
Year 2 is gonna be 0.15.
0.15.
Can I see the year 3 figure now? Yes. 0.23.
2.23. Okay. I think it looks like you're doing magic to others. So let's see what you've done. So we know that year 1, year 2, year 3. We're gonna make in dollars, $3, 4 million, and 6 million. And we know that this is profit before tax in the US. So what will be remitted will be after we have paid tax, and tax will be at 15%. At 15%, we'll be paying tax of 0.45 and 0.15, that's 0.6, and this will be 0.9.
I forgot to do this part
Okay,
where
let's
I'm
see.
supposed to detect the figures.
Yeah, let's go. Let's see. So which means the profit after tax in the US in dollars will be 3 minus 0.45, that is 2.55, 3.4, 5.1. So we have a profit after tax from this investment. This normally should be the whole thing that should be remitted to the UK, but we need to convert it to pounds. However, there is a 50% restriction. So which means the only amount that will be remitted, yeah, which will stand any chance of paying extra tax on in the UK, because the tax rate in the UK is more than the US. The only money that's going to come, if it was 100% restriction, there is no extra tax, nothing. However, because we're still going to get 50%, so which means 50% of 2.55, we'll get it, and that's 1.76. Let me use calculator. Let me not do it on top, or you can do it on your calculator for me to faster. 2.55 divided by 2, that's 1.28 actually. So we're going to remit 1.28, 1.7, and 2.5. So that is what will be remitted every year. So if that is what will be remitted in dollars, we need to know what is it going to be in pounds. So in pounds, because you can't apply tax rate of UK over dollars, it doesn't make sense, right? So you need to convert to dollar. And I've given you the exchange rate. I gave you at $1.3 is £1. So $1.3 is £1. 1.28 will be divided by 1.3. Yeah. So that's 0.98. So in pounds, that's 0.98. 1.7 divided by 1.3 is 1.3. And the last one is 2.5. That's 1.92. So which means this is the amount remitted in pounds. So we're going to pay extra tax. It's going to be on these figures every year. So that's going to be tax payable. But something that you need to be very careful of is, remember that this is post-tax. Very important. So this is the amount that has been remitted to the UK, but in terms of post-tax, that we need to charge this 10% extra, because currently as we speak, UK at 25%, US at 15%, means there's extra 10% tax that we have to pay. So the extra tax rate is 10%. So first of all, to get our extra tax, so we need the extra tax rate, which we have estimated to be equals to 10%. Yeah. And that would be on just 50%. Only on 50%. Because that is what has been remitted. And what has been remitted is going to be 50% of what we have made. How much did we make? We make $3 in year one, but in dollars. Let me break it down for you. So this remittance, because we can't charge tax on profit after tax, actually, please take note. Yeah, that's what has been remitted to us. Yeah. However, we need to know that our tax that will be charged will be on profit before tax. So which means I will do for year one, it's going to be 50% of the GBP equivalent of my year one profit before tax, then times my tax rate. That's 50%. The, the GBP of PBT was 3, but to convert it to PBT to GBP, I need to divide by 1.3 because I gave you the exchange rate, and the extra tax rate is 10%. Which means for my year one, I have 0.1 times 0.5 times 3 divided by 1.3, and that is 0.12. So my extra tax is 0.12. So even when they are giving me 0.98, 1.3, 1.92, I still have extra tax now. So when you are doing your cash flow and NPV calculation, you cannot just stop here and say this is the money coming into the parent. You need to consider the extra tax that would be paid. Same thing you do for year two. 4 divided by 1.3 times 50% times 0.1. Yeah, then you have 0.15. So we have extra tax of 0.15. And same thing for year three. Yeah, PBT 6 converted to pounds. 50% of that is what is being remitted, and it's going to be taxed at 10%. And that is 0.23. So if they're asking you, if you're asking yourself, what is my extra tax? For each year, these are the extra taxes that you will need to include in your cash flow estimate. So even if you are getting additional money, yes, but there's also additional tax to be paid. So your cash flow projection will not be complete if you don't take that into considerations. Well, like I said again, these are the things you will practice more as you solve questions. But for now, it's just more like we're just touching it, just introducing them to you. But at the same time, at least get the concept right at this minimal stage before we get to complicate it. Yeah. So those are the key things, like I said, where you can get a lot of confusions in addition to what you have learned in FM. Everything you've learned in FM is definitely examinable in NPV here as well. So they can add your taxation, they can add working capital, they can add inflation issues to it, and still expect you to estimate your exchange rate. They expect you to know what impact of taxation would be on intercompany transactions, on remittances, restrictions, and all of that. So all of that will be tested. But once you are able to get your cash flows, just know that the work is finished. Yeah, your work is finished because you are only going to ask yourself once you know your foreign cash flows. Let me try and break it down in steps for you. So the foreign cash flow is your step one, which is where you will meet all the complications. Once you're able to plot your cash flows, similar to FM, cash flow is the major thing. Once you apply your foreign cash flows, you're good. So this foreign cash flow in your step one, please make sure is after tax, because you will always pay your tax in the foreign country where you are. Extremely important. Once you have this, the best thing to do is to just convert those cash flows to foreign cash flows, convert the foreign cash flows to home currency, to parent currency. Yeah. Then you can now make any home adjustment to it. So if there's any, so adjust for any parent relevant cash flow. So if maybe there is extra cash flows in the home country, then you need to add to it. If there's any extra cash flow or tax that needs to be paid or whatever it is, then you add to the what you have converted. Remember, you have converted to the parent currency, so that's when you can now make additional deduction for it. Once you have done that, then you can discount. That's it. and use your discount factor, then you get your PV. And that is it. It's as easy as that. So where your major problem will come from is you being able to estimate your foreign cash flows. Yeah. So I'm not going to go further on this one because, like I said, virtual classes are not classes that I would like to drag for too long. Yeah. When we meet next week Friday, we'll go into calculations. The whole of next, no, the whole of next week will be mostly calculations. So we're getting into the deep of it. Now, please try as much as possible. Revise those concepts that I've mentioned today, those areas of confusion is very important. That's why I took time. And that's always been the approach I like to use. Not just jumping into questions, but bringing them out in isolation before we start seeing them all lumped together.